Good afternoon and welcome. My name's Bill Woodruff. This is the quarterly insights call for Wealth Factors review of global financial markets and investing. Before I get too far into things, I want to clear out some compliance language first. Uh, this call is for informational purposes only and may be recorded. Statements made during this call are the opinion of the speaker and are subject to the risk and uncertainties, some of which are significant in scope and by their very nature outside and beyond the control of Wealth Factor. There can be no assurance that such statements may prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future results or performance. I appreciate everybody tuning in, and let me jump right in with some quick background and introduction. So I've been focused pretty narrowly in investing for about 20 years now. A very broad experience set that includes building trading systems for a hedge fund, manager research and due diligence across most investment categories and types, including private equity, private credit, private real estate, equity strategies, and a fair amount of debt and fixed income investing. In my professional background, I've launched and been responsible for the investment activity of a mutual fund. I started WealthFactor in 2017, largely for the purpose of removing what I believe are a variety of unnecessary layers as well as complexity in the average investment service that's provided to most investors. So, Wealth Factor is a firm focused on building tools and technology specifically designed for the end investor. It's my belief there's a lot of technology and innovation going on right now. However, it's largely focused for the benefit of the investment professional. And really, the industry has been built that way for a long time. And I think because of that, it's why we're seeing some of the polar opposite services come out, whether it's the Robinhoods, where it's really built for consumers. I think that the tough part about that polar opposite consumer-driven, technology-driven product is they aren't being designed in ways that are likely to lead to long-term and sustainable positive outcomes from an investment perspective. Robinhood is the poster child of this. Encourage activities that probably aren't consistent with the types of investment tenets that have led to sustainable and long-term investment success. To just briefly to share a little bit about how we think about the world from an investing and global financial market perspective, Wealth Factor's investment philosophy is called Risk Smart. And it draws from a variety of large global asset management firms, investment techniques, but would generally be categorized as evidence-based and largely passive or buy and hold oriented. And Risk Smart has three different focal points. The first is being portfolio smart. And so some of the key elements there are keeping it simple. Avoiding complexity is I think a critical element in investing success. And when there are a lot of layers, when you hire a financial advisor who has a firm that he works for, and then they use outside mutual funds and potentially other types of funds, really quickly the layers and then therefore the complexity start to compound. Layers are expensive in addition to being complex. So avoiding layers is a key element of being risk smart. Additionally, and this tilts more to evidence-based and passive investing, we think it makes sense to generally try to avoid picking and or timing when it comes to the execution of the actual investing. The second component part is fee smart. So having the fees that one pays make sense relative to the services being provided. Getting exposure to a diverse portfolio of stocks is easy to do with ETFs and very cheap. And so I think the days should be gone where somebody pays 1% to an advisor who's largely investment oriented and then goes out and puts money in other funds. Granted, in the last several years, the industry's really shifted to a focus on selling financial planners and financial planning services as an attempt to justify and maintain high margins and high fees. And there's definitely some validity and value to those sorts of fees. But being fee smart is really understanding the layers of fees that are oftentimes in the industry, and really making sure that there's a value for the services that are being provided. The last element is in being risk smart is tax smart. Tax should not be an afterthought, but oftentimes is in a focus on selling performance, which I think is part of what the industry. What a lot of people assume the industry should be doing is trying to sell performance or provide some sort of outperformance. And I think a lot of the activities that one might do, including picking or timing, are pretty tax inefficient generally and aren't all that tax smart. And so here at WealthFactor, we've built systems and tools where we take indices and utilize our tools to do things like gains avoidance on a personalized level, as well as tax loss harvesting. So let me transition into some of the prepared comments for what's going on out in the markets. So I like to start things off kind of at the highest level and then dig in. And as if you've participated in any of my calls before, I never really dig in too close into what happened in a prior quarter. I think those sorts of there's so much information that's constantly hitting investors from all angles, whether it's salesmen, aka financial advisors, trying to pitch a product or a service, or the media. And I don't see any value to spending a whole lot of time on what happened last month or what happened last quarter specifically. I don't look at it as useful or predictive in helping us in going forward. So with that, the first page here, I'm going to focus in on the stock part of this. And basically what I'm showing here is the 1 year dispersion for stocks. And so you can see a high of, and this only goes back to 1950. So if you actually went back into the Great Depression, you'd see slightly greater extremes, but not by a whole lot. So up 47 in the best 1 year and down 39% in the worst 1 year. And so I think it's always important to think about investing to the extent that you're worried about what happened in a quarter or trying to predict what might happen in the next quarter or next 1 year. I would argue that's not really investing, that's speculating. It's a very different animal and should be thought of very differently. And in all my experience, it isn't often sustainable anyways, and probably isn't a good use of time. So what I would highlight here is really that investment element, in that if you're buying and holding a diverse portfolio of stocks, and this particular is for stocks is the S&P 500, which is generically used. The longer you hold those, the smaller the dispersion of historical outcomes has been. And so let's just start out with thinking about things with the long-term time horizon. This is one of my favorite studies, and the orange bar is the average investor, and it's a study. It's based on a study by a company called Dalbar, where they take the net aggregate mutual fund sales or purchases and redemptions and exchanges each month as a measure of investor behavior, and then we compare that to what do indices do. And what this study suggests is that because of us being humans and thinking we ought to, and probably the industry and the media conditioning us to think we should be picking and timing or trying to find the next best manager or whatever that might be, this study suggests that because of those activities and human behavior in general, the average investor or most investors underperform properly diverse buy and hold portfolios. And it's my belief it's largely because of those activities or the idea that they ought to be trying to be a benchmark. But the practical reality is annualizing 6 or more % per year is oftentimes more than enough to meet people's goals and objectives or whatever their positive outcome might be. And it's far simpler and far less risky in terms of the negative potential outcomes. Last quarter, I spent a little bit of time looking at earnings and how the markets have done after hitting all-time highs, and we've generally seen markets continue to do well since the last quarter. And I wanted to add a little part to that. I hear a lot of people say, "Well, the Dow is at 30,000; it's an all-time high." And really, price is not hugely useful as you think about it. It's really, you have to think about price change over time as relative to the earnings of the underlying businesses. And so in this graph, I think if you're thinking about the Dow as being an all-time high of 30,000 or wherever it is, 36,000, it's that's not really useful information. And this graph, I think, does a nice job as to explaining why. So if we look back all the way back into the late 80s, we have earnings per share on average for the S&P 500 at 25. Well, we fast forward to potentially in 21, 22, it's approaching 10 times as high. So if you took the Dow at 3,000 and took it times 10, a 10x return, that takes it to 30,000. So I think it's important to acknowledge that there's a link between earnings and earnings growth and the prices of markets over time. Certainly, and this is what makes investing so challenging, is the publicly traded global financial markets tend to be a voting machine and will fluctuate very dramatically based on changes in recent and near-term news. So oftentimes discipline isn't as easy as it sounds. Another thing I spent time on last quarter was growth versus value over time. And I found this graph since then that looks much further back. So if you look at the last 10 to 20 years, you see kind of an oscillation between value outperforming growth after the tech bubble bursting, and then growth outperforming value since, and really specifically in the last 5 years. And I see a lot of investors leaning very heavily to growth stocks today. And it's really, I think it's human nature to see investors gravitate to what did well yesterday, but generally, with long-term time horizons, those sorts of tendencies haven't proven to be useful. And then what this graph indicates is not only should one probably be at best balanced, in my opinion, between, this is a little bit of my opinion and a little bit of what this graph shares, but be balanced in their allocation between value and growth. But long-term historics actually tilt to value over growth. So for investors that are tilting very heavily to growth-oriented investments today, I think I would strongly encourage them to reconsider those decisions in favor of something that's more neutral for two reasons. One, growth has had an incredible run, and markets, all types of markets, tend to have cycles. And two, over very long periods of time, value has tended to outperform growth. So growth and value is an interesting thing to kind of pay attention to. U.S. and non-U.S. is another thing, and there's long-term cycles for both of them that I think are very interesting. And it's easy, especially during very strong periods, especially for what's easiest for us to understand, which would be large U.S. companies that are growth-oriented and exciting stories, but this graph here is the purple are periods where non-U.S. stocks outperformed U.S. stocks, and the gray is when U.S. stocks outperformed non-U.S. stocks in the last several years. And then, as you can see in this graph, over the last 10 years plus, it's been U.S. has largely outperformed non-U.S. But I think this graph helps illustrate that that's not always the case. And I think it builds a case for the inclusion, not just for the diversification benefit, but probably for more reasons than that, inclusion of non-U.S. in a properly diversified portfolio. Shifting gears over to fixed income or debt, and I'm gonna take a pit stop in with inflation. Inflation was a really hot topic in 2021, um, and this graph shows why we saw a pretty material spike to levels that we haven't seen since the 80s in the measures, inflationary measures, which is material. The thing that I would caution people against is drawing the assumption that that line will continue in its path. I mean, if you go back through multiple decades of spikes in inflation, every single one of them ended in inflation falling. And so we don't have no one has a crystal ball. No one knows what's going to happen with inflation tomorrow. And I think it's a mistake to assume that we should try to know and base investment decisions on that. Um, so there's global financial markets are incredibly complicated. What drives asset prices and inflation is there's too many variables that we cannot predict that will drive where inflation might go. And I think again, to let this have this be a reason to deviate from an investment plan is likely a mistake. Okay, so transitioning over a little bit more into the interest rate side or fixed income side of what's going on in financial markets. So the Fed gets a lot of attention, and rightfully so. But it's important to note that the Fed really influences interest rates only at the very short end of the curve, minus perhaps their asset purchasing programs, which they're unwinding currently, or at least indicating they're going to accelerate unwinding of some of those. But to keep the focus simple, it just on them setting short-term interest rates. And so this is the graph of short-term interest rates going back to 2000. We can see the long period after the financial crisis where they're at zero, and then they came back to the zero following the onset of the pandemic. The dotted lines, the first one is the blue one is what the Fed is indicating. Fed meets, they share information in that meeting, and then they share their minutes. And so the blue line represents their what they've shared with global financial markets and investors, and the green line represents what the market actually believes is going to happen. And the reason why I think this is important is because global financial markets, are incredibly efficient. And as soon as the Fed minutes gets released within hours, or potentially even faster, the information is digested. And oftentimes there's a ton of volatility on that one day. But for most investors, minus those that are, built businesses around trying to anticipate what's going to happen and pick and time investments, for most investors, this information isn't useful at all, in my opinion. And that's because of how fast this information is already getting priced into markets. And so when we think about bonds, which is where we're going next, is and not wanting to own a bond because of the concern of inflation or rising interest rates, well, we don't have any information that everybody else doesn't have. And that's largely priced into markets already. And again, I think it's a mistake to be trying to be predictive around what's going to happen. So I think that one ought to better focus on what's the right amount of risk for each individual and their situation, or each entity in its situation, and not spend their energy trying to predict what might happen with inflation and or interest rates. So this is another graph that I think is informative and probably builds a little bit of a case as to why investors may want to maintain or consider maintaining exposure to fixed income if that is a good fit for them. So the purple line on the bottom is August of 2020. And the x-axis is time, is length of maturity. So on the far left, it's 3 months, and so effectively what the Fed can control, and then all the way out to 30 years on the right. And so the second line, the blue line, is the year end, December 31st, 2021. And so we can see visually what happened to the shape of the yield curve. So as inflation picked up, as the Fed indicated they're going to raise short-term interest rates, we saw market interest rates start to move in anticipation of those increases in the short-term rate. And so we saw, where in August in 2020, 3 months to 7 years, there was no yield. 36 basis points. That's a fair amount of interest rate risk and getting very little to no compensation beyond what you can get in cash and taking no interest rate risk. Well, fast forward, just barely over a year later, that 7 year yield is now up to 1.44%. And so if you think about that in terms of interest I'm receiving, it's fairly material in terms of the difference between 36 basis points, 0.36%, and 1.44%. And so, again, I'm not trying to make a case that I believe interest rates are going to fall or interest rates are not going to rise. Simply a reflection that I'm getting far better compensated today for taking a bit more interest rate risk than I was in August of 2020. It's interesting to see that if we go look all the way back to December 13th, when the Fed had rates at zero following the financial crisis still, just exactly how steep the shape of the curve was at that time relative to now. I think you could also conclude that, with the Fed likely, or at least indicating next year that they're going to raise short-term interest rates, the most of the rest of the curve has probably factored that in already. What's like this, granted, so many things can change, but let's pretend for a second other things, markets don't change. But so the Fed's the only thing that acts from here on out. The curve will actually flatten, assuming no other changes in all the things that will likely change in terms of the direction of the stock market and inflation, et cetera, that will drive this entire curve between now and then. Again, re-emphasizing exactly how complex this is and how impractical it is to try to base investment decisions on predicting these elements. So that concludes the prepared comments. I am, if